Hey everyone, me Kevin here. There's been a lot of fear about stagflation. We've heard that TSA check-ins are going down, that more airline tickets and travel are getting canceled and rescheduled to the future, and hotel room reservations are declining. We're starting to see this sort of delta slow down at the same time we are at peak levels of inflation, and bond yields are going up. But is there a secret truth to what's really going on here that might not be as bad as we expect, especially coming up to the CPI data release Tuesday at 5:30 a.m. Let's talk about this and some opportunities and how I am investing through all this madness. Folks, first, today though is 9/11, and my heart goes out to everyone affected by 9/11, and I hope and pray that we never have such a horrific terrorist attack again. Let's now, folks, get into a talk on inflation and stagflation. First, this is a screenshot from the Bloomberg terminal. Thank you very much to the Bloomberg terminal for allowing me to post this here. Take a look at this. This is a shot of news trends for references to the word stagflation through the Bloomberg terminal, which sort of consolidates all news. What's crazy is it skyrocketed just recently within the last few weeks here. Even though we had really high inflation over here, and inflationary readings and fears of high inflation staying were really exploding over here in the February to March timeframe. In fact, you could see that by looking at the 10-year Treasury yield, right? 10-year Treasury yield exploded under fear in February and March, but we haven't gotten a stagflation fear until just recently, the last few weeks. And it's worth trying to figure out why would folks think that stagflation is a concern. Well, a lot of it has to do, in my opinion, with Delta. It makes sense. We're seeing those slowdowns. Again, travel, airlines, hotels, things are slowing down. This makes sense that at the same time you would have a slowdown because of Delta and super high inflation, that you might think the economy is starting to stagnate while maintaining high inflation. But are these high inflation levels a real concern? Or is there something that we should specifically be paying attention to that might give us some more clarity for us being on a path to potential normalcy again? Well, let's break that down. So, CPI data that comes out this Tuesday, 5:30 a.m. California time. I will be live streaming that, so make sure to subscribe to watch that. And if for some reason you're not getting all of the YouTube notifications, make sure to type into the Apple or Android App Store, Meet Kevin, and download the free Meet Kevin app so that you always get notified every time a video is posted, if that's what you want. Okay, so this Tuesday, we're expecting month-over-month inflation to come in at 0.4% and year-over-year inflation to come in at 5.3%. This is really, really high. And looking at this on the surface, it's like, oh my gosh, this is crazy. Like, we're at a slowing down market because of Delta or economy at the same time as high inflation. This is bad. Well, now we've got to look at the details because, as usual, the devil is in the details. Things that have led to high inflation over the last few months have been things like wedding dresses, I kid you not, that's one of the categories, used car prices, airline tickets, and lodging. Well, we already know that lodging, TSA travel, airlines, these are slowing down. So we expect some pressure to be lifted off of these prices and these prices to stabilize because of Delta. We also know that used car prices have been skyrocketing, but according to the Manheim Index of Used Car Price Values, we've actually seen a stabilization of used car prices. You could see that right here. We previously had been skyrocketing, and this is why we had some crazy inflation here, starting specifically in February, right around here, because this was really weighting inflation up. And that's really slowed down here. Now, there are two things that could make inflation continue to be bad. But this right here, so far, we should be going into the CPI read, the CPI print, expecting it to come down because all of these things, the travel, lodging, and used cars, slowing down. But the two things propping up inflation right now, or the potential two things that are going to prop up inflation, are wages, especially in lower waged industries like local retail or local services. That's a danger, local service inflation, and rents. Those are the two big things, that is wages and rents, that we're expecting to potentially prop up the CPI print and inflation print. And how much of a prop up we get is going to be really, really important to this market because everything related to this CPI print is going to give us answers on will the Federal Reserve begin their taper or not. In other words, This Tuesday, if we get a miss on inflationary expectations, inflation via the CPI comes in lower than expected, whether we believe it or not, the Federal Reserve is likely to pause on that taper until November, and we hope to have a beautiful September and October rally in the stock market until the beginning of November. Doesn't mean we don't have other uncertainties going on. We still have a debt ceiling debate. We've got a big infrastructure debate. All that's happening at the end of this month here in September. So there's still going to be plenty of room for uncertainties, so to speak. Plenty of room for the market to go down and fluctuate up and so on. But for me, I'm hoping the CPI print comes in lower than expected, so that way the Fed delays their taper. We do not get the taper this month. We don't get a taper announced until at the earliest in November. Potentially, we kick that can down the road, and we start seeing inflation inflect to the downside. But could this potentially lead to hyperinflation? I don't think so. And I'm going to prove to you why, and then I'm going to show you a second piece of evidence that has to do with what the bond market is doing, which is very, very interesting. So buckle up for that one. By the way, while I pull this chart up here, if you like my analysis or you find my analysis unique, I guarantee you're going to find my analysis and perspectives in my courses link down below extremely unique. If you want to save money investing in real estate, doing property management or rental renovations, you want to be an agent and make more money, you want to be a YouTube content creator, or you want to invest in the stock market, learn about fundamental analysis, TA, options, whatever, check out the programs down below. I regularly add content. I'm finalizing some new lectures this weekend as well for stocks and psychology of money. Check out the coupon code link down below. You could use that coupon code through September 24th, and then the pricing will go up again. Pricing always goes up about $50 every single time a coupon changes. All right, folks, take a look at this. This here is a chart of forecasted inflation in the United States. What I think is really neat about this chart, and again, shout out to the Bloomberg terminal, love this software. What I think is really neat about this chart is it tells us that, look, we saw this high inflation. This has already happened. This was in the past. We're right about here right now. We're at peak inflation right now. But because we've been on this recent roller coaster, we feel like we're just on this perpetual up of inflation. And unless the Fed tapers, unless the Fed slams on the brakes, we are going to see hyperinflation. But it's worth noting that the baseline forecast for inflation, no matter how long this stays up or high or elevated or how fat this bubble is right here of inflation, the forecast is that by 2023, we will be back to a pretty stable inflationary time, where inflation is sitting between 2 and 2.5%. That's symbolized by this solid white line. But watch this. What if Kevin is right and inflation comes in lower than expected? Well, if inflation comes in lower than expected, then the dotted line right here might be a potential path that we would take, where inflation basically came hard, came fast, but then finally inflected down, slowed down, markets rallied, and we were able to cheer that great, inflation was indeed transitory. Okay, but Kevin's not always right. I recognize this. I acknowledge when I make my mistakes. And as much as I still think I'm right about my inflation, and I am long on tech and innovation because of this, what if inflation comes in high? Inflation comes in high, then we'll get this fat red over here. And inflation might last longer. Look at this. We could have 5%, 5.5% inflation basically lasting into halfway through Q1 2022. That would be like 5% inflation going to February, March of 2022. Be crazy, right? Yes, in the short term, it'd be crazy. But look at what the long term always does. The long term in all forecasts and all economists and every researcher, everybody seems to point to the same thing. By 2023, we would expect inflation to be well under 3% and continue to converge to that 2.5% level, potentially even 2% in some cases. But this is a long run expectation. So what's important about this is if you are a long-term investor, remember, inflation is something that is going to be here for a period of time. The question now, is it going to be here for 6 more months or 2 more months at 5% levels or not, right? That's the big question right now. And so some people are looking at the 10-year treasury yield to try to predict what does the market believe. And there's actually something very interesting happening in the 10-year treasury yield. And this is worth talking about. This is a little bit trickier to follow along, but I believe you come to my channel to get insights that you're not getting anywhere else. And that's why you subscribe to my channel and come back to these videos. Take a look at this, folks. When inflation expectations first skyrocketed, we saw 10-year Treasury yields skyrocket. This makes sense. If we think there's going to be high inflation, then we see 10-year Treasury yields go up. And at the same time, if we think there's going to be high inflation and 10-year Treasury yields are going to go up, then we're going to expect tech stocks to go down, high valuation stocks to go down, and things that print money today doing much better. That is very well cash flowing companies now doing better. Maybe even like real estate or whatever. Industrials, right? Anyway, what's fascinating here is we've had this crazy uptrend. Then we've had this slow down trend. But look at what's happening over here. Since about the beginning of August, we've actually had another uptrend. Now, why would we have an uptrend? Well, ordinarily, we might look at this and say, well, we're having this uptrend because we're expecting inflation to go up. That's it. The CPI print's going to miss. Inflation's going to go up. That's it. Inflation's going to keep going back. And the bond market is pricing it in again. Maybe not. And this is the mind-blowing part. Wait, Kevin, if the market is not expecting high inflation, especially during this Delta surge kind of stagflationary time, stagnating time is better, and maybe inflation expectations will inflect downward, why would 10-year Treasury yields go up? It could be because of something known as the shorts covering. See, when short sellers buy Treasury bonds, they're covering their shorts. Because remember, when you short something, you sell it, you dump it, right? Well, what if over the last few months, short sellers realized, crap, inflation is going to be temporary. It is going to be transitory. Now, over the last few months, they start buying back their treasuries. Okay, so they buy back treasuries, they close out their shorts. Now, people who were buying treasury bonds like crazy don't have to buy treasury bonds anymore because they're covered. Okay, so in other words, where we saw yields going down right here, this down path right here and this excessive sort of fall over here could have actually been treasury short sellers buying treasury bonds back. Because when people buy a bunch of bonds, the yields fall. Now, they don't have to be buyers anymore because they've already covered. And now you have less buying pressure in the market. And so yields are slowly trickling back up because the short sale covers, the people covering their shorts aren't adding to buying pressure anymore. And so the yields are slowly going up as treasury yields are slowly falling. So in other words, this sort of weird transition we've had in the bond market right here, at least the research that I've done, could actually be a natural indicator that the market is expecting lower inflation. And while expecting lower inflation, we're seeing this kind of slow trickle up in 10-year Treasury yields. Kind of interesting, a little bit of a mind twist, and the reason it doesn't perfectly look that way in the chart is because you have to remember that when people buy Treasury yields or buy Treasury bonds, prices go up and yields go down, right? It's that weird inversion thing. And if none of that in the last minute made sense, let me just give you a bottom line on this part of the last minute. If shorts covered their short seller positions on Treasury bonds, then we could see exactly this happen, where basically the market says, yeah, inflation's going to inflect down. We're not going to short the market anymore. Let's just get out of this shorting the Treasury market, expecting inflation is going to slowly inflect down and eventually taper all the way back down like we saw in the forecast chart. And we're going to get out of shorting this market. That would lead to basically a plummet in yields and then a slow rise in yields, which is exactly what's happening here. So in other words, even though we're seeing this trickle up, super bottom line, epic bottom line, and then we're moving on from this, epic bottom line is the slow trickle up could be a good thing for the market, could be a good thing for tech and innovation. Okay, now, what do we invest in? What the heck do we do? So my belief has been very consistent. I'm a big fan of it being heavily exposed to tech and innovation. I'm over 80% exposed to tech and innovation. The safest of them, obviously, FANG T. Those are going to be Facebook, Apple, Amazon, Netflix, Google, Tesla. So there's a double A in there and the T at the end, right? It's expanding FANG a little bit, FANG T. Then if you want to go out on the risk curve a little bit, you could go to like AMD, Nvidia, the chip suppliers. These guys have been killing it. Want to go further down the risk curve? You go to things like Etsy, Enphase. Further down the risk curve, go to things like Affirm, Lemonade, Hippo. These are more risky, but other opportunities. All of these, in my opinion, are innovative plays, going from safest, the Fang T, to least safe, most risky, potential highest risk, highest reward, like Hippo, Lemonade, Affirm, right? All of these, in my opinion, are going to do very, very well. Could be wrong, but I think they're going to all do very, very well in a deflationary time, where we start getting that inflation inflecting downwards. I believe that weaker inflation plays, with inflation rotating down, are going to be things like retail, travel, our usual recovery plays. I still think there's room for speculation in these. I think there are opportunities to buy the dip and sort of ride them up and then sell out of them. I'm a big fan of this. I did a big call option last week on Dave & Buster's that was very profitable because of earnings. So thank you, Dave & Buster's, for that. That was an awesome one. But things that you want to keep in mind here are what you want to invest where there is elasticity of demand. Elasticity of demand is basically, am I going to buy a new iPhone if it's $1,000 or $1,100? Does that extra $100 make a difference as to whether or not I'm going to buy this phone? If the answer is no, it doesn't make a difference, I'm going to buy it anyway, you have more elasticity of demand than if you go on Google Flights right now and you're like, oh, flights to Canada are $400. Oh, but if they're $500, I don't want to pay for it anymore, right? That would mean you'd have less elasticity of demand. I believe travel has lower elasticity, especially during Delta, whereas tech and tech-related services, software as a service, these, I think, have very large elasticity of demand. People are going to pay for higher prices and they're going to pay higher costs. That is, if we have some inflation that we have to pass on to consumers. I think that's the place where people are going to pay it. So that's why, for me, big fan of staying long on tech, because eventually we're going to hit that curve of going down. How long it lasts remains to be seen. But remember, folks, the curve moves down in the long run. And I think that is very, very, very important to remember. So I will see you Tuesday morning at 5:30 a.m. I hope you subscribe to the channel. If you like this kind of perspective, always make sure to check out my programs linked down below. Go to mettkevin.com/join, use that coupon code. Folks, thank you very much for watching. No matter what happens this Tuesday, I'm excited for my plays, but my options are going to fluctuate based on what happens. But that's part of trading in the market. All right, folks, thanks so much for watching. We'll see you in the next one. Bye.